Hey guys, welcome to the Silver Report Uncut. So it's been almost a month or so that I've been living out of Airbnbs and hostels, and it's just really not working so much. I don't know. I've kind of determined that I don't got much of a choice but to go back to my vehicle, which I thank God that I have, and because things have been tough out here and really uncertain, and it's making me fall behind on a lot of things. And some backstory: I don't get the AdSense on this channel. We're entirely listener supported. And if you wanted to help out, and you can do that in the description, there's several ways. I also set up a Patreon now because I didn't really use it too much before, but it's just patreon.com/Silver Report Uncut for people that wanted to actually become dedicated supporters of this channel, because for the most part, you have to go where the money is and focus where money is for right now. And a lot of my focus, it ends up being on making it from day to day and then figuring out what's going to pay right now, trying to get clients, and it's hard keeping up. So I could devote more time if I actually had an income coming in from this channel, because it's really breaking the economic engine there. So let's get into what's going on with Europe and this banking crisis, because there is a lot of systemic risks right now. And for the most part, they're sweeping it under the rug. But Deutsche Bank is the latest headline after Credit Suisse. Everyone is aware of Credit Suisse. They had enormous obstacles with a lack of profitability, but Deutsche Bank was recovering from years of losses. Since 2019, Deutsche Bank, they launched a solid rebalancing plan. The goal was increasing the return on tangible assets to 8%, a massive cost-cutting initiative and a shift from investment banking to their core lending activities. And after these years of losses, the core capital ratio grew. Profits began to emerge, indicating the apparent success of their plan. But Deutsche Bank, they followed the recommendations of authorities and the central bank to the letter. No strategy can counteract the erosion of the balance sheet caused by monetary policy and regulation. So Credit Suisse, Deutsche Bank, Silicon Valley Bank are not the root of this banking issue. They're just symptoms. The banking industry was not damaged by rate hikes. It's a zombie economy. But these are years of negative interest rates, monetary excess. During a time when negative interest rates were destroying their primary business, European banks did all they could to become modestly profitable and bolster their balance sheets. And according to the ECB, at the end of 2022, the aggregate common equity tier 1, or the CET1 ratio, it was 14.74%. The aggregate tier 1 ratio was 16.03%, and the aggregate total capital ratio, it was 18.68%. So this negative interest rates, it's destroyed the bank's profitable assets. Most assets do not create a profit above the cost of capital for banks. So the investment risk, it has surged during this period of monetary excess. This was really, really warping any kind of risk analysis. What risk? They're bailing out the banks. They can do whatever they want. They can take the greatest risks in the world and make a fortune. And, people will lose all their property, their real property, but they just get bailed out. And central banks, they constructed this ticking time bomb, essentially, that is now going off. This insanity of negative interest rates, this perpetual quantitative easing has destroyed the money supply. Even during these moments of growth that they created, they pulled that all forward, and now it's coming due. They made the assets with the lowest risk and volatility, sovereign debt, really expensive and volatile by acquiring bonds without control. What took place in 2022 is significant as well, because central banks reported huge losses on their portfolios of national bonds. In 2022, the ECB reported losses of 1.6 billion euros that they had to be covered by reversing provisions. The Federal Reserve and the Bank of England, they had huge losses as well. This financial void caused by the central bank's accumulation of safe assets became the limit for many firms. And these identical unrealized losses in commercial banks, when combined with negative returns on loans and deposit losses, they spell disaster, and the bank's equity evaporates. So how is it possible? Regulation is actually the cause of this void. According to regulation, taking risks in the public sector does not require capital because there's no risk involved. Negative interest rates are mandated by regulation through the supervisors, and the regulation penalizes the increase of the cash ratio. So it's the supervisor who creates the risk in sovereign bonds by purchasing them uncontrollably while printing money. So it all points back to the central banks, to the fiat currency. And the major issue is centered on the star financial instrument of these years. Regulation and oversight prompted banks to issue contingent convertible bonds. But these bonds, they're not without danger. Low-risk bonds do not yield 10.4%, especially when they have negative interest rates. So these, with a 19% yield from German banks and a 15.7% yield from French banks, it does not imply that they're inexpensive, but rather that they have a high risk. And there's no return without risk.